I mean, the flows in tech have been strong, and I think, look, we're back to the rate cut bets. And I think you have to try and think about, to the comments that Alarian was making, you did at the top of the program there, is that, if those rate cut bets aren't realised, that the sector that's probably going to suffer the most is tech, because it's been a lower rate play. So yeah, no, I would agree. I think, if money rushes back into one sector, it's going to be vulnerable if that theme begins to unravel. And right now, it seems pretty unclear to us how the Fed ends up cutting rates by year end.
But as we went into Davos, it seemed that the narrative from the first week or so of trading was very much the Fed is not far away from ending the rate hikes. And actually, if you want to go and find some value, emerging markets are the place to do it, or the China play is the big opportunity here. Any reason to vary from that view and to pile back into the tech stocks that Karen was talking about at this point?
Well,
and firstly, do you agree with that narrative?
Look, so I think the China reopening play, which is the other theme that's been running alongside the Fed rate cut hope, I think that has more legs, because we do know that China has reopened and is reopening far quicker than anyone anticipated. And I think, we talked a bit about positioning. And cash holdings, the one area that is, in contrast to tech, which is crowded, the one area which is very underweight and undervalued is emerging markets. And so I think that's a much safer way to play this kind of risk on that we've had for the last few months for it to continue.
What's safe about buying emerging markets when they've got all their dollar funding to come at higher rates than they've had and with a stronger dollar? I mean, that's an old playbook, isn't it? You don't buy emerging markets with a strong dollar in town.
Well, but that's the other flip side of this, of course, as well, as the dollar is obviously, well, and look, the dollar has had a very, exactly to your point, has had a very strong inverse correlation with risk appetite. And so that's partly why we've seen the dollar come off as risk has improved.
Even when, again, we've talked a lot in 2022, all of us, I'm sure you do as well, about various kind of pivots. And the pivot that the market's finally got round to might be okay is actually not raising rates anymore, not cutting them. So even if everybody slows down on the inflation front and they slow down on the hiking front, and Waller's right, and we're going to get 25 basis points this time around, plus maybe one more of those to come as well. We're still going to get a Fed funds rate which is way higher than, of course, the BOJ, way higher than the Bank of England, way higher than the ECB, the Riksbank, the SNB, etc., as the great Yul Brynner once said. So why emerging markets when you're going to have higher? Why'd you sell the dollar? What's the short end? What was the 2 year I just said? 4.2%. Take your money.
Yeah, but I think this is the interesting thing, is that emerging market fundamentals have changed significantly. And so you're right, there are some countries that have got some dollar exposure, and if you think about the rates where they are, you'd say exactly, it's the area you should avoid. But this is the key point. It's the area that investors have already avoided. And they're underweight. And I think a lot of that bad news has been in the price. And actually, emerging market central banks did a terrific job getting rates up faster than developed market central banks, and are now going to be easing. So local currency bond markets in EM would also be attractive.